given the fact that the economy is going to decelerate, the only thing that can push yields higher would be a change in inflation expectations, meaning that one, you're going to get tightness in the labor market, and that's going to continue for the end of the year. There's probably going to be I calculated probably a 0.7% growth in the labor market this year, and that has more to do with, you can do like shortcut cheats with like productivity, and then the growth rate. So if you assume that the growth rate is going to be about I have about 2%, and you assume that productivity is going to be about 1.3 to 1.5%, which is probably going to be what real earnings are going to be. Real wages are going to be 1.5, maybe 1.7. They could get all the way to 2%, but it doesn't seem likely given the fact that, again, you know, we're down to a very limited amount of labor that can come back into the economy. You know, when I say that's just the way that it all works, I just don't know exactly when that's going to happen. You know, and I'm no better at calling it, you know, than saying the same exact thing that I said in April of 2018, which is, you know, that the equity market will be lower by, you know, at some point in either the third quarter or the fourth quarter. You know, and that's almost unavoidable at this point in time. But for your portfolio, the bond market will be substantially higher. And you know, like I said, if you add duration and you expect that the Federal Reserve is going to cut rates, which is what kind of the yield curve is indicating, and all the forward, the futures on the overnight index swaps and federal funds futures are sort of indicating at this point, is that it's much more likely, and they haven't really deviated from. They're more than likely, given the situation in Europe and given the situation in Japan, and given the yield differentials in the advanced economies, it's just more likely that capital is going to continue to flow into the U.S. economy, and that the dollar is going to continue to be the burden of the beast of burden for the rest of the world, and the U.S. consumer is just going to be the engine, the relatively slow engine of growth, but the engine of growth for the rest of the world, at least over the next three to 4 months. And eventually, the U.S. consumer is going to break down, and that's not going to be able. They're just not going to be able to do it. And when that happens, that's when the market will fall off, and you know, you'll get a substantial increase in volatility. And if you short the market at three, you know, if the equity market goes on, and when I say the equity market, I mean the S&P 500. If the S&P 500 goes to 22,900, if it goes to 2950, if it goes to 3,000, I would say short the market, because at that point you're looking at not only an equity market trading almost 18 times future earnings. And then if it goes to 3,000, you're looking at something trading at 19 times earnings, and I think earnings are only going to be about 3% growth this year in terms of the S&P 500. You know, the market's not going to be able to stomach that going into a decelerating economy, and not only that in the U.S. but also in the world. So dollar has to make the adjustment. All those things have to happen at some point. I just don't know when they're going to happen. But when they do happen, that's ultimately what's going to happen. But everything as of right now, it's the trade deficit should get significantly worse during the second quarter, because U.S. wages are substantially higher than all of our trading partners. Real wages in the U.S. are substantially higher than all of our trading partners. Productivity growth isn't high enough that it will decrease labor employment. So once productivity growth goes to 2%, and if we were to get back down to trend growth at 1.7%, then you would have a drop off and a fall off in labor employment gains. And that doesn't seem likely to happen in 2019. It's probably much more of a 2020. Oil. Take a long on oil and interest rates, and take a short on the overall market. And remember, I said if you were to do that at some point in time, the market being up 13%, I think it's very likely that the market could go up as high as maybe 20% if foreigners and share repurchases can push the market all the way up to 3,000. Or, you know, even if it gets to 3,100, you have a very good short opportunity going into the second half of the year, because that money has to come out of the U.S. And has to go in a different direction, and that will weaken the U.S. dollar. All these things that typically have to happen at the end of a cycle have to take place, and all I'm saying is that being long oil, being short the dollar, being short the equity market once it reaches its pinnacle, and then also being long interest rates, because the Federal Reserve is much more likely to remain accommodative and to be more expansionary in terms of its policy decisions as the U.S. economy starts to slow down. But keep in mind that anytime the Federal Reserve is cutting rates, that could substantially change those outcomes, or provide additional upside catalysts for a much longer period of time than typically is normal. And like I said, I think that has to do with the fact that if they cut rates, they're also probably going to engage in some level of quantitative easing, where they're actually going to be repurchasing mortgage-backed securities or U.S. Treasuries with the principal payments that they receive from investing in those assets.